why does it feel like the market's against you, and why every time you open a trade, it just loses? Well, there is probably a good reason for that, and it might not be what you think. I can tell you it's not just bad luck or that the market gods are against you. Well, maybe a little bit in your case. Just kidding. Whenever I see people saying things like the trade didn't go to plan or every trade I open is a loss, when I dig a bit deeper, it's usually the same situation. Most traders structure their trades with favorable asymmetric risk-reward ratios. It's what everyone's taught to do, and in most cases it makes the most sense for the situation because that's a big reason why you're deciding it's an opportunity in the first place. So what do I mean by asymmetric risk-reward? It's really simple. It means that one side of the potential outcomes is larger than the other. So, for example, if we have a favorable asymmetric risk-reward ratio, it might mean that we're risking a loss of 1 to make a potential profit of 4. In practical terms, if we look at the trade as an example, we have our stop loss set to 20 pips and the potential profit is 80 pips, which means it's a 1 to 4 risk reward. Now, just to be clear, most of my trades are asymmetric, so I'm not saying that that is inherently a problem. So the real issue here is perception. Let me explain. Let's say that you're taking the trade from the example before, but the problem is you have absolutely no edge in the market, which, let's be honest, in this case, for most traders out there, usually following some illogical trading approach. So with no edge, the probability of it being a loss is 80%. In other words, if you traded like that 100 times over, 80 of the times you would expect it to be loss and just 20 times a profit. Now, instead, let's say that you do have an edge, and that's why you are taking that trade. Smart move. Well, it would take a monumental trade of the century to shift the probability of enough that the most likely outcome is profit rather than a loss. Instead, we can, think of this way, and the concept of the having an edge is not that it means a profit is more likely than a loss on an individual trade. It just means that the probabilities are favorable enough that you will have a profit overall if you take the sort of trade time and time again. What I'm describing here is basically the expectancy of your trade, and the combination of all of this is what leads to your trader's equitation. If your trader's equitation is positive, then great, you are a profitable trader. If it's negative, you've got some work to do. But what is not showing you is that you have more profitable trades than losing trades. So now, if this concept is something you're struggling with or you want to understand better, I've got something that will help. In the description, you will find a link to my free Telegram channel where I will explain to you the logical formula for successful trading and many other things. It's full of insights and it will give you a whole new perspective on your trades. But let's bring this back to the key point here. When you open these sort of trades, you are expecting to have a loss. So when the trade does lose and then you go and say something like, oh, the trade didn't go according to my plan, well, that's not actually true, is it? Because you were expecting the result was going to be a loss, and then it was. But I have to admit, it feels a bit counterintuitive to open a trade expecting it to be a loss and still think that's a good idea. But you have to accept it and embrace it. Otherwise, you will fall into this negative spiral and end up just being like all the other losers in the market. Here's what I mean when I say about a negative spiral. So a lot of traders will accept that they are trading asymmetric risk rewards, and it's more likely that any individual trade will end up being a loss. On paper, that's all fine. That is until they actually start hitting the losses, and then all that goes out the window. They start hesitating, doubting their approach, without realizing it, they start to self-sabotage. So they will start making changes to try and avoid losses. They will tweak their system over just things and end up with their inconsistent mess rather than improving things overall. They will just end up securing themselves as a negative trader's equitation and a massive L that they can hold. I want to give an analogy here, but before this, remember to check the totally free Telegram channel in the description that will save your time, money, and energy. So we have there a lot of analysis, news, psychology, and even more. So let's go on. The one analogy I've got lined up for this situation is like a striker who can't score when Fernando Torres joined Chelsea. Practically overnight, it was like he was so bad at scoring that it seemed more likely intentional satire. Some might say that is just the Chelsea effect. London is red. But what happens when strikers hit these dry spells like Fernando Torres is that they start getting into their own heads. Rather than seeing it as just a probability thing or just a temporary dip in a form, they start overthinking and over-adjusting rather than continuing to do the right thing that they were doing before. They constantly change things until they get themselves into an absolute mess and their confidence is absolutely shattered. Bringing it back to trading, the key if you're going through a tourist mindset is to get yourself back to basics. Reconnect with the probabilities of your trades and understand how likely it is to go through a losing streak when you're trading with asymmetric risk rewards. I also see this all the time when traders analyze their data. Let's say you've been going through a bit of a slump, so you've not been getting the result that you thought you would. Over the last, for example, 40 trades, you analyze what's been happening and you've taken nothing but trades with a 1-to-4 risk-reward ratio. With your system, you're expecting to have a 25% success rate, which overall would mean that you're profitable. But when you analyze those 40 trades, you discover that your success rate has only been 20%. So what a lot of traders will do is see that and think, 20%, that is not good. Then they will start worrying, going into this negative spiral, and actually, if you just stop panicking and look at reality, you would realize that 20% of 40 trades is 8 trades, and 25% of 40 trades is just 10 trades. So that's the difference of 2 trades, and with a small sample size of 40 trades, you can expect some variability. So 2 trades is really not that much. Being blunt and totally honest here, if you're losing overall with your trading, it's very likely to be because your trading approach is not saying that's the case for most traders. But before you jump to that conclusion, you have to understand the probabilities of your trades and allow your trading approach the chance to perform. So you have to allow the expectancy to play out over time, because before you can really judge where you are at. Having the right perspective is key for successful trading. And then once you've done that for a long enough period of time, you have a good enough sample size, you can start to analyze it to figure out if something does need to be changed or not. So guys, thank you once again for watching this video until the end. Don't forget to subscribe, share this video, and like. Also, don't forget to go in the description below this video. We have a wonderful Telegram channel, cool community. Yeah! So, see you next time, and bye.